Welcome to This Explainer. Today, we're popping the hood and decoding the world of financial accounting. Now, instead of thinking of accounting as just some dry list of numbers and strict regulations, I want you to imagine it as a high-performance factory engine. Every single transaction, every piece of paper, and every rule is a specific gear designed to keep that engine running perfectly. We're going to build this engine from the ground up, component by component, so you can see exactly how the anatomy of a business truly functions.
Here is our roadmap for today. 1. The accounting equation. 2. Tracking the paper trail. 3. From ledgers to statements. 4. Reading the financial story. 5. Sole trader or company. And 6. Rules, principles, and expenditures.
Section 1. The accounting equation.
All right, if our business is a factory, these are our fundamental building blocks. First up, assets. Think of these as the incredibly useful tools and machinery driving you forward. The key word to remember here is control. These are resources your business controls from past events that will bring future economic benefits. So we're talking cash in the bank, inventory waiting to be sold, and the literal machines on your factory floor.
Next up, we have liabilities. Simply put, this is what the factory owes to outsiders. These are present obligations stemming from past events, meaning an inevitable future outflow of resources. If you took out a bank loan to buy that machinery, or if you owe suppliers for raw materials, your trade payables, those are your liabilities.
Then, we reach equity. This is the ultimate goal for any owner. You take all your amazing assets, use them to settle your debts and liabilities, and whatever's left over, that's your equity. It's the owner's true residual slice of the pie.
Number 4 is revenue. If assets are the tools, while revenue is the fresh fuel constantly pumping into our business engine, it's the income that arises from your ordinary, day-to-day activities. Selling goods, charging service fees, earning commissions, this is the vital fuel keeping the lights on.
Finally, to round out these definitions, we've got expenses. Look, you can't run a factory without burning some fuel, right? Expenses are the costs required to keep the engine running. It's that decrease in economic benefits over the period, things like paying employees' salaries, covering the rent, paying for utilities.
So, let's look at this equation in action. Say you make a 1,000 rupee cash sale. Your cash asset goes up by 1,000. To balance the scale, your revenue, and therefore your equity, goes up by 1,000 too. Now look at a 300 rupee electricity bill. Cash drops by 300, your expenses increase, which brings overall equity down by 300. The scales balance perfectly every single time.
Section 2. Tracking the paper trail.
We've talked about some fairly abstract concepts so far, but how do they actually enter the physical world? They do it through an unbroken audit trail. Each piece of paper authorizes a specific gear turning in our factory. It's a complete life cycle. A non-binding quotation turns into a purchase order. When goods arrive, a goods received note proves delivery. Then comes the invoice, demanding payment. If something goes wrong, a credit note adjusts the balance. And finally, a remittance advice and a receipt prove the cash actually changed hands. Every transaction you ever record is anchored to one of these source documents.
Section 3. From ledgers to statements.
Welcome to the core engine room, where all this raw paper-based data gets processed. Let's follow a single credit sale step-by-step down the assembly line. Step 1, the transaction happens and you issue an invoice. Step 2, that invoice is logged into a book of prime entry, grouping similar items so we don't clog up the main engine. Step 3, we post this to the ledgers, updating the customer's specific account in the subsidiary ledger and the total sales in the general ledger. Step 4, we reconcile to ensure individual accounts match the master. Step 5, we make end-of-period adjustments. And Step 6, we extract those balances to create the financial statements. It is a highly structured, foolproof flow.
But here's the question you should be asking yourself as we move from granular mechanics to overarching outputs: what caused the change in equity? When you look at the beginning of the year versus the end, how exactly did the owner's slice of the pie get bigger or smaller? To answer that, we need the finished products.
Section 4. Reading the financial story.
The ledgers are basically thousands of messy turning gears, but the financial statements, that's our sleek dashboard. Each statement answers a critical question. The balance sheet asks, what's the company worth right at this exact second? The profit and loss statement asks, how profitable was the business over the whole year? The statement of cash flows asks, how did we actually generate and spend physical cash? The statement of changes in equity answers our previous question. what caused the owner's value to change? And finally, the notes to the accounts answer, what are the hidden assumptions behind all these numbers? Together, they tell a complete, undeniable story.
Section 5. Sole trader or company? Now, the mechanics of our engine never really change, but your business structure definitely alters the dashboard layout. If you're a sole trader, you keep the balance sheet simple, just one bucket called a capital account. You take your opening capital, add your profit, subtract the cash you drew out to live on, and bam, you have your closing capital. But a limited company, they are much more heavily regulated. They have to legally split equity into specific share capital, revaluation reserves, and retained earnings, which are those accumulated profits kept right there in the business.
And notice how they treat owner pay and taxes on the income statement. For a sole trader, taking money out is just drawings. It's not a business expense. Plus, the business doesn't show tax because the owner pays it personally. But remember, a limited company is its own distinct legal entity. If the owner works there, their director's salary is a strict deductible administrative expense, and the business itself gets hit with a corporation tax expense right there on the profit and loss statement.
Section 6. Rules, Principles, and Expenditures. This right here is the quality control department of our factory. Without rules, companies could manipulate their dashboard to show whatever story they want, so we have guiding principles to keep the system honest. We assume the business is a going concern. We use the accruals basis, recording transactions when they happen, not just when cash moves. We demand consistency and prudence. We value substance over form, but I really want to emphasize materiality. This is where accounting actually uses common sense. If you buy a €20 plastic wastebasket, theoretically sure, it's a long-term asset. But materiality says, please don't clutter the books depreciating a plastic bin over 5 years, just expense it instantly. Professional judgment matters. Speaking of expenses, our final crucial distinction is between capital expenditure, or CapEx, and revenue expenditure, or RevEx. If you buy a heavy machine for the factory floor that provides long-term value, creates an asset, and is depreciated over time, that's CapEx. But when you pay the monthly electric bill to keep that machine running, that's a short-term benefit for day-to-day operations. It's fully charged in the current year. That is RevEx. Mixing these two up is a massive quality control failure that can drastically distort your financial reality.
Which brings us to the end of the assembly line and to this final critical question. Does your financial engine accurately reflect the economic reality of your business? From the tiniest goods received note all the way up to the final balance sheet, every gear must turn in sync, guided by strict principles. Think about your own business or the businesses you might invest in. Are they applying these rules correctly? Are they treating their RevEx as CapEx to artificially inflate their assets? Understanding this structured, bottom-up anatomy gives you the incredible power to see right through the numbers. Thanks for joining me on this explainer. Keep learning, and I'll catch you next time.